All right, you know who's been waiting lately? Are gold investors, because they don't know what the heck is going on in the gold market, which is why David Morgan is here with us right now, publisher of the Morgan Report and silver-investor.com. David, I love when you come by. Gold hits an all-time high, and then bam, it falls right back down. I mean, the uncertainty is still there. You would think the gold trade would still make sense.
Well, I think longer-term trading does make sense, but what we're seeing here is a bit illogical, and let me explain. With all that's going on in the Eurozone, as you said prior, nothing's coming out of Europe. We really don't know. I think you said something about buying a bridge.
Right.
So with all that uncertainty, you would expect gold to be going limit up and making new high after new high, and it's not. And so what that suggests to me is that the paper traders or the overhang on the market is great enough, regardless of how it got there, that we're going to be in a high-level trading range. I really don't expect to see gold break through the $1,900 level for the next couple of months. I could be wrong, but that's how I see it. When you have these kind of markets and gold isn't reacting the way everyone expects, you got to stop and think, why is it not doing that?
And so why is it? I mean, you just said it. Europe's unknown. Economic situation here in the United States is not that much better. So is it just people took money off the table? It got to run. They needed some cash. They sold it off. And now we're waiting.
Several things. That's one of the prime ones. A lot of the hedge funds, when things went south in the stock market, they look at gold as a trade only. They look at their book. They're usually leveraged. They've got to get some cash fast. Gold's up, they sell it. And usually all of those people are on the paper side of the markets, either ETFs, futures, options, OTC derivatives, and on it goes. So even though it isn't physical gold, it still represents gold at some level, and you see it sell off. So there's a lot of people and hedge funds, managed money particularly, that's come out of the gold market. And I don't think a lot of them are looking to get back in at this particular time.
Before I start to ask you about the other metals, you know, they changed the margin requirements on gold, right? Basically want you to put up more money in order to invest in gold. Makes sense to me. Do you think that has pulled investors out of the gold market?
Well, it certainly puts the little guy out of the market. I mean, it happened in silver as well. They went up 4 times on margin increases, and they did it on gold a couple times, perhaps more. And it does. Anyone that's minimum margin that gets a margin call has to either sell their position or add to their cash position to keep, you know, in the market. And that certainly knocks out a lot of the smaller players. This happens again and again and again. But to be fair, it happens across the board. The CME does it on any market, not just the metals markets, when things get too frothy on the upside or the downside. They've been fairly consistent with that. You
know, I equate it to nowadays when you buy a home, you got to put 20% down. You know, prior to this, they only wanted 10. Now they want 20. I mean, it just makes sense, right? You got more skin in the game. You got to put more money out there. So let's talk about silver. You said same thing happened in the silver market. Silver's actually having trouble finding its way as well.
Absolutely. I mean, I can make a strong case that silver went parabolic once QE2 was announced, went from roughly the $26 level to almost double, went up to almost 50, and then there were 4 margin increases as it was approaching that level, and then it got slammed down, touched around the 33 level, consolidated for several weeks around 38 to 40, then lately was consolidating 38 to 40, and then once gold went parabolic from roughly the 1550 level up to about 1900, and the margin increases went there, and it got slammed down. Then silver, sympathized with gold, went down even further. In fact, it even touched the $26 level or just above it intraday. A few trades got off there. A lot of people that were in the futures market saw 26 or low 26 level as a real opportunity. A bit of buying came in and popped right back up. Obviously, we were trading around 30. And just to back up a bit on the gold scene, since this uncertainty in Europe is so strong, what we have seen is gold go from about the 22nd of this month at about 1620 all the way up over 1700. So we had an $80 move in just a few days. So certainly the market is reacting to the euro problem, but again, not to the oomph or the extent that we might expect with, you know, what's the prior price high. So it's not making new highs, but certainly it's reacting.
I got to ask you about copper now too. We saw copper pull back, and then we saw China start buying it again. We saw China manufacturing numbers come out saying, you know, hey, China's still doing just fine. Are we going to see copper start to top up again?
I think so, and I do look at copper fairly regularly, and I have to state that the Chinese are pretty darn good at getting physical commodities at good prices. They know how these future markets work, and they're pretty good at selling them off and getting prices to a level that they're comfortable buying wheat or corn or rice or copper or any of the hard commodities, because let's face it, there's a lot of paper trading that goes on in all of those markets. Nonetheless, the real commodity underlying those derivatives is needed worldwide. So I would say what you suggest is absolutely true. It's probably needed by the Chinese. They are buying physical because they want it. And how much China's going to slow down or not, I think it will, but obviously they're not going to have no demand for copper. They know how much they need, and they may be warehousing it. The thing about metals that's so intriguing is that you can store metals basically indefinitely. You couldn't do that with most of the foodstuffs.
Yeah, and that's a great point. Okay, so big picture, where do we see this commodity market still going up? I mean, or are we going to see some, because of what's going on globally, people talk about these global slowdowns. Do you see it pulling back at all?
I do. I think we're going to see a high-level consolidation to the downside over the next few months. I think once this euro problem is resolved, and it never is really truly resolved, but the perception is that things are okay and we're going to muddle on through for some period of time longer, I think you'll see the commodities sell off a bit. They're going to consolidate. Longer term, I'm still extremely bullish on the commodity sector, but these kind of conundrums with the financial markets, especially the currency markets and what's going on with the euro, are going to take some wind out of the commodity sales, I think, for a while. So I'm still bullish longer term. On the mid to short term, I'm a bit cautious, but buying, because I see these things as opportunities, but I can't call an exact bottom in here. I think they're going to trail off, but that doesn't mean to be fearful. It means to take advantage of the situation, just have the correct time horizon.
Right, so you're basically saying dollar cost average your way back into this stuff.
Absolutely.
You're great. David Morgan, I love talking to you, publisher of the Morgan Report and silver-investor.com. Come back soon, sir.
Tracy, always a pleasure. Thank you.
Yeah, you too. It's good stuff. David's great.